You're about to hear something most commentators won't say out loud until the damage is already done. Something that might rewire the way you see every so-called revolution on the markets, and how hype silently turns into a liquidity trap. You'll get the key insight in a few minutes, the kind that separates those who survive the next downturn from those who get erased by it. Stay focused, because what follows isn't another prediction. It's a dissection of how capital disguises itself as innovation. They say AI is the new electricity, the new industrial age, the new everything. But what if this age isn't powered by intelligence at all, artificial or otherwise, but by greed, leverage, and the desperation to keep a financial engine alive? The question isn't whether AI will change the world. That's already happening. The real question is whether the world can afford the price tag Wall Street has attached to it. In early October 2025, the Bank of England quietly released a technical note that barely made the evening news. It warned that valuations across the AI sector had become stretched and that a sharp correction could occur if investor sentiment shifts. Central banks avoid using the word bubble. They prefer overextended, unsustainable, excessive, but the meaning is identical. When an institution responsible for monetary stability starts hinting at instability, that's not background noise, that's the system whispering to itself. And here's the irony: the warning didn't come from critics or short sellers. It came from the very establishment that helped create the environment for the bubble to form. Years of low rates, quantitative easing, and the belief that liquidity is infinite. That belief becomes unbreakable until it breaks. Liquidity is a drug that feeds on its own availability, and the AI narrative became the newest delivery system for that addiction. Patterns don't lie. Every great innovation has carried a bubble around it. Railroads, electricity, the internet. AI fits the same curve. The technology is transformative, but the financial structure built around it has turned into something detached from physical reality. Market valuations are pricing not just future growth, but a perfect, frictionless, instantly profitable version of the future. That's not innovation. That's financial hallucination. Independent studies from multiple institutions in 2025 confirm the mismatch. Over 85% of companies integrating AI systems reported no measurable return yet. They're spending heavily on infrastructure, data pipelines, and computational resources, but the monetization curve is slow. The market, however, behaves as if all of that potential has already converted into profit. The distance between expectation and reality has never been wider. Capital follows language. Over the past year, global liquidity has clustered around anything labeled AI, from ETFs to venture rounds, from chip manufacturers to cloud providers. One word became enough to move billions. Analysts stopped asking, "Does this business make money?" and started asking, "Does it sound like AI?" That shift in narrative changed how capital itself behaves. Money stopped chasing productivity and started chasing words. Nvidia became the gravitational center of this phenomenon. Once a chip maker, now a symbol, its valuation turned into a reflection of belief. Belief in infinite demand, infinite margins, infinite future. When the company exceeded earnings expectations, entire indices rallied. When it merely met them, markets trembled. At its peak, Nvidia wasn't priced as a business. It was priced as a myth. A single ticker became the heartbeat of an ideology that AI equals salvation, but symbols don't scale forever. Eventually, reality demands proof. Physical limits are the silent enemy of exponential stories. Power constraints, data center energy demands, and supply chain bottlenecks are already testing the limits of scalability. AI training consumes energy on an industrial scale. The fantasy of endless compute meets the physics of finite infrastructure, and when a market narrative built on infinity meets limits, panic follows. It doesn't require a crash, just a pause. Momentum evaporates, algorithms reverse, and the same traders who swore AI was the new oil start asking how to short it. The risk isn't just in valuations, or it's in structure. A growing portion of trading systems now use AI-based signals to execute high-speed strategies. When sentiment shifts, these systems react simultaneously. Their logic isn't emotional, it's mathematical. That synchronization can amplify volatility, creating self-reinforcing cascades of selling or buying. In extreme cases, the system can trigger the very instability it was designed to exploit. The feedback loop becomes a weapon. That's the hidden danger. AI doesn't just exist inside the bubble, it runs the bubble. It processes the same headlines, interprets the same signals, and trades on the same expectations that created its own valuations. It's recursion. Hype feeding on code, code feeding on hype. The system becomes self-referential, and once the loop breaks, correction is instant. The logic is brutal but simple. Markets don't need to crash to correct. They only need belief to weaken. Once liquidity starts contracting, narratives collapse faster than fundamentals. We've seen this sequence before. Crypto, EVs, green tech. Each innovation survived, but the valuations didn't. Every time, the technology outlived the story. AI will be no exception. Psychologically, the pattern is textbook. Every mania starts with truth, grows on exaggeration, and ends in disbelief. Awareness, mania, delusion, collapse. The AI cycle sits squarely in the delusion phase. Everyone knows valuations are extreme. No one wants to be early leaving the party. That's the paradox. Rational people acting irrationally because they assume everyone else will stay just a bit longer. Investors Investors defend positions by appealing to transformation. This time, it's different. They point to adoption curves, automation, and trillion-dollar market projections. But the numbers betray the story. The average AI firm's valuation has grown 10 times faster than its revenue. The market has priced in perfection, and perfection never survives contact with reality. This is where psychology merges with liquidity. Markets aren't rational systems. They're emotional engines with price tags. Every rally strengthens belief. Every correction tests faith. AI became the perfect vessel for modern belief. The idea that technology will fix everything, even the system that broke it. That's why the narrative feels religious. It's not just about money, it's about salvation through innovation. But when belief turns into valuation and valuation into leverage, the correction becomes theological. The structure holding the AI boom isn't technology, it's faith in liquidity. Faith that interest rates will stay low enough, that capital will stay cheap, that demand will stay infinite. When that faith breaks, the illusion unravels, and what's left will reveal the divide between those who built technology and those who sold the story. The next part goes deeper into the anatomy of the bubble itself. You'll see how incentives, not conspiracies, engineered this illusion, how institutions, funds, and narratives merged into one feedback machine, and what it takes to survive the unraveling, because when the story ends, the only thing that matters is what remains real. The anatomy of a bubble is never mysterious. It's mechanical, predictable, almost biological. It begins with narrative, grows on momentum, and matures into self-deception. The AI bubble followed this blueprint with precision, not because of malice or conspiracy, but because the market's survival depends on storytelling. The first stage was signal inflation. Every institution, every fund, every media outlet needed to be seen as part of the next technological epoch. Analysts began using the same vocabulary. Transformative, inevitable, once in a generation. It wasn't analysis, it was ritual. The words themselves became currency. Reports were written not to describe reality, but to manufacture consensus. This created the illusion of universal agreement. When everyone repeats the same conviction, dissent feels irrational. Fund managers, fearing underperformance, began reallocating capital not on merit, but on narrative safety. No one ever gets fired for buying the future. As liquidity pooled into AI-linked assets, valuation followed narrative, and narrative followed price. A closed circuit, perfectly efficient in its irrationality. Then came the institutional momentum. Pension funds, sovereign wealth funds, and major ETFs had to participate simply because benchmarks demanded it. Passive capital doesn't analyze, but it mirrors. Once a few dominant AI names captured index weight, inflows became automatic. The system started buying itself. That's the point of no return. When markets turn reflexive, early price action creates justification, and justification fuels price. By mid-2025, this reflexivity reached systemic scale. Every rise in valuation justified further capital rotation, which in turn lifted valuations again. Analysts began adjusting models after price action, not before. The logic reversed. Instead of value determining price, price defined value. It's the hallmark of late-stage euphoria, when mathematics becomes theater. Inside this dynamic, companies learned to speak the language investors wanted to hear. Earnings calls turned into AI performances. Phrases like neural optimization, synthetic data pipelines, and autonomous scaling filled transcripts, often detached from measurable outcomes. The objective wasn't accuracy, it was resonance. The more futuristic the tone, the higher the stock responded. The feedback loop between language and valuation became absolute. Meanwhile, the venture sector began its own version of the race. Startups that had nothing to do with machine learning rebranded overnight. Marketing firms became AI-driven customer intelligence. Logistics apps became predictive autonomy networks. The purpose wasn't technological, it was financial. Funding requires narrative velocity. The more revolutionary the pitch, the faster the check clears. Venture ecosystems are mirrors. They reflect what the public markets reward, and at that time the markets rewarded prophecy. This created a secondary layer of leverage. Narrative leverage. Each success story inflated expectations for the next. Each headline justified higher valuations downstream. A single acquisition could reset the entire pricing structure of a sector. Investors stopped analyzing revenue and started extrapolating destiny. If this company was bought for 20x sales, the next one deserves 25x. That's not analysis. That's collective hypnosis with spreadsheets. The media, predictably, amplified it. Every boom needs a choir. Reports framed the rise of AI not as a cycle, but as a civilizational turning point. It's seductive. Humanity outsourcing intelligence to machines, the promise of post-scarcity, the end of human era. But behind the grandeur hid a simple truth. Most of the capital was not funding intelligence, it was funding belief. Billions moved not towards solving real problems, but towards sustaining the illusion that progress equals profit. When that illusion starts to fracture, the first cracks appear not in headlines, but in liquidity. Trading volume concentrates in fewer names, volatility increases on minor news, and option premiums expand. It's the sound of faith losing cohesion. Institutions begin to to hedge quietly while maintaining bullish tone publicly. Markets don't crash when people panic. They crash when confidence erodes in silence. By late 2025, silent hedging had become visible in derivatives data. Skew levels in major AI-linked indices began widening, a subtle signal that large players were protecting downside while retail sentiment stayed euphoric. It's a classic divergence. Smart money rotates out, retail money doubles down. The handoff is never announced, it just happens, smoothly, mathematically. But the system's danger isn't limited to price, it's structural. AI's expansion demanded unprecedented data center construction, semiconductor demand, and power consumption. Each of these sectors, in turn, leveraged future expectations to finance current capacity. That means debt was being issued based on unrealized technological outcomes. If the growth curve slows, the financing chain tightens instantly. It's a domino field built on momentum. Energy constraints are already forcing recalculations. Power grids in multiple regions reported data center loads surpassing projections by 30–40%. When energy becomes the limiting factor, scalability halts, but capital doesn't tolerate stagnation. When growth flattens, valuations lose their mathematical justification. That's when sentiment turns. And when sentiment turns, liquidity follows. The bubble doesn't burst from bad news, it bursts from disbelief. One missed quarter, one delay in chip supply, one regulator questioning data ethics, and the illusion of inevitability evaporates. Once people realize that perfection was priced in, every small imperfection becomes fatal. Multiples compress, algorithms reprice, and the cascade begins. At this stage, human psychology collides with automated logic. The majority of institutional flow today runs on quantitative triggers: volatility thresholds, momentum signals, sentiment parsing. These systems don't panic, they execute, but their synchronization produces outcomes indistinguishable from panic. When a narrative unwinds, all models detect it simultaneously. Selling becomes systemic, not emotional. The correction feels sudden, but it's been mathematically inevitable for months. And here's the part few understand. Corrections in the AI sector won't resemble traditional crashes. They'll fragment. Capital will rotate rather than retreat. Some segments, infrastructure, chips, core software, will consolidate. Others, speculative startups, inflated SaaS hybrids, and will vanish overnight. It won't be a single implosion, but a slow deflation masked as sector rotation. The system prefers gradual decompression over visible collapse. It preserves credibility while erasing excess. In financial history, this phase always ends the same way. Not with outrage, but with fatigue. People stop caring about forecasts. The words AI revolution lose their emotional charge. The dream remains, but attention moves on. That's when the cleanup begins. Mergers, write-offs, quiet bankruptcies. The same cycle that began with hyperbole ends with silence, yet within that silence lies opportunity. When the noise dies, signal returns. Real technologies, those with measurable impact, sustainable economics, and authentic utility, start to emerge from the wreckage, but that process requires clarity. The next phase isn't about speculation, it's about filtration, separating intelligence from illusion. The next part will expose what drives that filtration, the underlying power structures, how capital reallocates after disillusionment, and what kind of entities thrive when hype collapses, because that's where real advantage forms, not during mania, but in the aftermath of it. Every cycle leaves survivors, not the loudest, not the fastest. The ones who understood the game beneath the game, because in markets, intelligence isn't measured by how much you know, but by how long you can stay rational while others hallucinate. After every mania, power reorganizes. When the AI bubble decompresses, capital won't disappear, and it will migrate. The smart money will shift from abstraction to infrastructure, from the idea of intelligence to the plumbing that sustains it: compute capacity, energy, connectivity, memory. These are the real veins through which the next economy will breathe. This is what most retail investors will miss. They'll chase the brands, the logos, the tokens of the movement, but the long-term alpha won't be in the faces, it'll be in the foundations. Whoever controls the bottlenecks, chips, data pipelines, energy distribution, will own the tempo of the digital age. AI itself isn't the product, it's the consumer. It devours computation, bandwidth, and electricity. If you understand that consumption pattern, you can position ahead of the migration of value. That's the real play. Not betting on AI, but betting around it. When a gold rush begins, you don't need to find gold. You need to sell shovels. The market doesn't learn this. It relearns it. Every generation repeats the pattern. The internet bubble created Amazon, not because it avoided the crash, but because it built infrastructure that survived it. AI will follow the same archetype. 95% of projects will vanish. The rest will quietly redefine the baseline of civilization. Now, about investors seeking extraordinary returns. The paradox is brutal. The higher the expected return, the lower the probability of survival. That's because asymmetric upside comes from asymmetric perception. Once everyone sees the same next big thing, its alpha dissolves. What remains is leverage and hope. Both are expensive illusions, but there's a window, a narrow one, between collapse and consensus. It's the moment when mainstream belief fades, but the underlying trend remains real. That's where generational opportunities form. The task isn't to predict when the bubble bursts. The task is to detect when the narrative shifts from faith to fatigue. You'll know it when media coverage softens, when valuations stop responding to AI in headlines, when venture funds quietly diversify, and when infrastructure providers begin to outperform application companies. That's your timestamp. That's when capital is rotating from story to structure. Institutional investors already know this. That's why the quiet accumulation of assets in energy, semiconductor foundries, and data center rates has accelerated over the last quarters. These aren't speculative plays. They're ownership of the substrate. The world can survive without a new chatbot, but not without the chips that run it. Meanwhile, sovereign funds are starting to view compute capacity as a strategic asset, not a commercial one. Nations now treat silicon like oil. Whoever controls supply chains of advanced chips controls leverage over every digital economy. That's why the AI race is no longer just corporate. Is geopolitical. And when economics becomes geopolitics, volatility is structural. It never ends. So, what should the rational investor do inside this storm? The answer isn't romantic, it's architectural. Diversify across infrastructure layers of the AI stack. Compute, energy, data logistics, and cybersecurity. These aren't trend plays, they're inevitabilities. Build exposure not to the narrative of intelligence, but to the materials that intelligence consumes. But the second rule is psychological. Don't worship the future. Markets are machines of collective emotion. They reward detachment, not belief. Every trader eventually learns that conviction is dangerous when it becomes identity. The ones who survive every cycle treat narratives like software. They install, use, and delete them when outdated. Never let a story own your portfolio. And finally, timing. The best entries are never the most exciting ones. They're the moments when enthusiasm has died, when talking heads declare AI fatigue, when volume evaporates and valuations normalize. That's when the air is clear enough to see the real signal. Buy when belief is scarce, not when it's loud. The truth is, this decade will belong to intelligence, but not in the way people imagine. It won't be about machines replacing humans. It'll be about systems replacing attention. Whoever controls your cognitive bandwidth controls your reality. AI is the next layer of that control architecture. Financial, informational, perceptual. The bubble is just the surface phenomenon of a deeper restructuring. The integration of human cognition into algorithmic governance. That's why the end of this mania won't be the end of AI. It'll be the end of innocence. Markets will realize that intelligence isn't a feature, it's infrastructure. Once that clicks, valuation logic will shift permanently. AI will stop being a sector and start being a substrate. Just like electricity or the internet, invisible, indispensable, unpriced until absent. When that moment arrives, the true players won't be the startups with clever names. They'll be the silent monopolies, the data brokers, the chip makers, the power providers, the ones no one posts about because their charts look boring. That's where the real asymmetry hides. The future will reward patience. The irony is that in the age of speed, patience becomes a superpower. The crowd trades emotion, the elite accumulates structure. And so, when you hear the next wave of euphoria, but when everyone says this time is different, sometimes remember the pattern. The story always changes. The mechanics never do. Narrative inflates, capital rotates, liquidity drains, silence returns. The only constant is human psychology, our hunger for acceleration, our fear of missing out, our refusal to sit still while others appear to move faster. But markets don't reward motion, they reward alignment. The AI revolution isn't overhyped, it's misunderstood. It's not about artificial intelligence, is about the intelligence of capital, its ability to adapt, reallocate, and survive its own delusions. That's the real organism, and it's still evolving. So when the next correction comes, and it will, don't see it as destruction, see it as purification, noise burning away until only signal remains. That's where you enter. That's where the real wealth forms. Quietly, rationally, inevitably, because the game was never fair, but it's always been winnable. For those who see through the noise.